We will now discuss the concept of discontinued operations a bit further, as well as understand how earnings per share, or EPS, is presented on our company's income statement. So discontinued operations, we've defined that as a component that has clearly distinguishable cash flows and operations. Some recent examples were Pfizer's sale of its nutrition business to Nestle back in 2012, also H.G. Heinz' sale of frozen desserts business back in 2013, and lastly, Google's sale of its smartphone subsidiary to Lenovo in 2013. So discontinued operations, these are the disposals that represent a strategic shift in policy that will have a major impact on the company's future. As you recall, GAAP requires separate reporting below income from continuing operations, which allows our reader, such as the investors and creditors, to make much better decisions and also do a better job of forecasting the future recurring cash flows. Let's now review the sample income statement excerpt reflected on this slide. What we see is a discontinued operations loss of $1.32 million, which is reflected as a separate line item. Keep in mind it's reported net of tax. It's a separate line item as discussed before we report our true bottom line, the net income of $21 million. Next, we talk about earnings per share, or EPS. It's a ratio that indicates the amount of net income expressed on a per share basis. Keep in mind that EPS is different from dividends. While EPS is simply the ratio of the income calculated on a per share basis, dividends are truly the cash payments we receive as a shareholder. The EPS is the only ratio presented on the face of the income statement, or actually any financial statement for that matter. There are two types of earnings per share calculations. First, we have primary earnings per share, which is most common, and then we have diluted earnings per share, which is a bit more confusing. So the primary earnings per share calculation is net income minus our preferred stock dividends divided by our weighted average of common shares outstanding. Does everyone think they understand this EPS calculation? I'm going to move over to the whiteboard now so we can illustrate how we calculated primary earnings per share. Okay, we've talked about two types of earnings per share calculations. I'm going to demonstrate the primary earnings per share because that's the main one we see in our income statements. So here's a set of facts. The company has a net income of $600,000 this year. We also have preferred stock dividends of $75,000. And our shares outstanding are 1 million to start the year, and then another 1 million issued on March 31. So keep in mind, for a primary earnings per share, it's net income minus those preferred stock dividends divided by the weighted average of outstanding shares. So if we walk through the math of this, it would be the net income of 600 minus the 75, which gives us 525,000 available for our shareholders. And then our weighted average would be the $1 million that we start with, and then basically the million shares that we have for 3/4 of the year. So again, if you do the math on this, we come out with 525,000 divided by a weighted average shares outstanding of 1,750,000 shares, and that comes out to basically 30 cents per share. Keep in mind, that is not the same as dividends per share. So this company may have dividends of 15 cents per quarter, so their dividends may actually be 60 cents, but their EPS reflects only 30 cents. And that's the difference between earnings per share and dividends. Hopefully, the whiteboard example made more sense out of the earnings per share calculation. Our second type is diluted earnings per share, which reflects the potential dilution of earnings if and only if the denominator, the weighted average shares of common stock, could be increased. So in other words, if certain securities such as bonds can be converted into common shares, or if there's various stock options, which are usually issued to your senior management as described in that proxy statement we've discussed, once they're exercised, then the number of common shares of stock increases, which basically causes a dilution or reduction of the earnings per share.